Good afternoon. Welcome, everyone. Thank you guys for joining us for our kind of pre-holiday season webinar with Payability, where we're talking with Alex Sklar about understanding the financial landscape, specifically when it comes to small businesses. And hopefully you guys have been listening to the episodes that Alex and I have been doing over the past few weeks. Everyone say hello to Alex. Alex, thanks for joining us. Good to see you in person over the internet.
Thank you for having us.
As you guys know, I'm Kate Valentine. Alex is the head of business development and strategic partnership at Payability. I am going to turn the time over to him. He does have a presentation for you guys, and afterwards we will get to questions. But during the presentation, if you have any questions that come up, feel free to put them in the chat. I'll save them. And when we get to question time at the end, that's when I will go through and we'll answer them as they've kind of come in. Feel free to kind of chat with me too in the chat as well. But I'm going to mute myself, turn my camera off. I might pop in and out if I have a couple follow-up questions just as we're going or any housekeeping notes. But and one note, if you have to duck out or you miss any of this, we are recording the webinar. We will send it out to you all later as well so you can review. But Alex, I'm going to let you turn the time and introduce yourself and kind of giving you the show from now.
Well, thank you. And for a little background on myself, I grew up working in a family business, and I started my own service company actually right after college. That I sold a couple of years later. I've built 3 different businesses. I've worked in public accounting, and for the last 7 years, I've been in financial technology. I currently work at Payability, connecting marketplaces and e-commerce ecosystems to financing and payment solutions to better enrich their clients' experience and help businesses of all sizes grow. So, what we're going to be talking about today. So we're going to go over the financing landscape and what that looks like. We're going to talk about what types of options there are for different businesses. We're going to talk about what some of the qualifications look like, understanding rates and terms, and then ideally, how do you benefit? So let's get going. To kind of kick off, I usually like to start with a little disclaimer of sorts. Everything you're going to hear is based on my own firsthand knowledge and experience. There are literally thousands of different financial institutions out there, all of them different. And I don't claim to be an expert on everything financial. I would always suggest you do your own homework on any financing decision. But my goal is to kind of take us through this webinar and introduce us to some of the most prevalent financing options and how they work. One additional note is there are 2 main types of financing available. There's debt and there's equity. In this presentation, we're going to be focusing the conversation on different types of debt and similar to debt financing. So let's get going. So as we can see on the screen here, there's a lot of different options when we're looking at financing in general. And I think that businesses of all sizes tend to be overwhelmed when trying to discover all the financing options out there. Whether we're researching through blogs, whether we're looking at lenders' websites, talking to colleagues, maybe attending trade associations, or just even talking to friends, the information never seems to be readily available, concise, or informative. Oftentimes, we just work off of anecdotes we hear from others. And when we have the word cloud up here just to kind of show you some of the terms you may have heard, but maybe you've heard some different anecdotes from people you've talked to. SBA loans have the best rates. Just put everything on a credit card. Ask the seller for financing. Why don't you just go to the bank? Oh, you should look online. Why don't you go talk to my friend? And on and on and on. And I think what happens for different business owners of all types is we tend to hear this information. We don't really understand how to process it. We don't understand what options are right for what types of companies. Are these options even available for me? And it can just sometimes be overwhelming, and we just kind of hit a point of, decision paralysis without really knowing what all the options were. So, among these many comments, we want to be able to kind of break it up and dig in to what there is out there. So, what are my options? I think when we're talking about options in general, one thing I usually like to do is kind of ask ourselves a couple questions. How fast do I need the funds? Let me start over. The three questions we kind of want to ask ourselves are: what's most important to us? How fast do I need the funds? Having the most time to pay it back, or having the lowest rates? Depending on how we answer these questions, different options become available. So, let's kind of break down really quickly just a little bit of those questions. So, how fast do I need the funds? I think the truth of the matter is the faster you need money, the more expensive it can be. And that's not necessarily a bad thing. It makes sense once we understand why. And we'll talk more about this a little more in like a later section when we talk about what banks and what lenders are looking for. But first we need to understand that there's risk of not being repaid by every financial institution when they deploy money to a business. Whether that's a person that's lending, whether it's a person that's receiving a loan or even a credit card, or whether it's a business, anytime a financial institution sends out money, there's a risk they may not get it back. So underwriting, and that's a term everyone should be familiar, if you're not familiar with, I'd love you to just understand what it is. Underwriting is the method financial institutions use to diffuse and lower that risk. The more time a financing company has to underwrite your file, as well as the amount of information they have to work off of, the lower the rate, as their risk has been lowered by having all that information. The shorter the time period and the less information they have, the higher the rate tends to be, and that's to mitigate the risk that the lender is taking on. Having the most time to pay back and lower payments. Some products have longer times and thus lower payments. This can be easy to manage in the short term, but you could end up paying more over time depending on how the rates work. So we always want to be, and we'll talk about this more in the APR section, but what we need to understand is stretching the amount of time we have oftentimes creates a longer duration of interest that we're going to be paying. And oftentimes to be able to have that longer time, it means that we're going to be in a longer process of getting approved. And the same kind of goes for lower interest rates because it goes back to the risk portion we were talking about before. So when we're looking at options, additional questions that we can see on our screen are you willing to put up collateral? Do you want to specify how you're going to have to use the money? Do you want to create a business plan? And then what is the money going to be used for? Is the money for growth? Is the money for an emergency? Is the money to smooth cash flow? All these different types of questions can have an impact on the type of financing you're looking for, the length, the rates, and the terms. So it's best to kind of give yourself a plan going into it about what you're trying to achieve with the capital. Are you buying inventory? Are you looking to smooth out cash flow so budgeting is easier? And all these different types of questions. It's whether you want to create a business plan or not for a lender, we all should kind of have one for ourselves a little bit, or at least have an action plan of what we're trying to accomplish. So to dig in a little more on what some of these options look like, we also want to understand, am I purchasing something? Am I purchasing inventory? Am I purchasing equipment? Do I have a warehouse that I'm looking for maybe a forklift or, racks to put inventory on? Am I looking to buy the building? All these different types of questions lead us to different answers. So when we take a look at the screen here, I think it's interesting to look at like all the different types of options that are typically available for businesses of all sizes. So we have, working from our left to right, and just a kind of disclaimer, the way this chart works is it doesn't work linearly in that, we have some items on the column on the left-hand side, like the maximum amount, times and days, collateral, minimum FICO. But The terms that you see won't always equate with the minimum FICO. So if we're looking at the SBA 7A, you might not get the full 25-year term if you only have the lowest FICO acceptable, which is 650. So just kind of want to lay that out as we're looking at the chart. But here I'm trying to put in some high-level ideas of just if you've never heard of these type of financing options so you can see them. So working from left to right, we have SBA loans 7A, we have USDA loans, which is a fantastic program that is, it's typically designed for rural areas, but I think oftentimes business owners are shocked when they find out what the government considers a rural area. So, very good programs there. Pardon me. So one thing to note about the SBA loan and USDA loans is they are backed by the government. So a bank is putting out a certain portion of the money, and then they're being compensated essentially, or essentially selling portion of that to the government. So the government's taking on the risk and not always the lender. Because the government's involved, the time to be able to receive a loan is usually much longer. Typically, it's between 30 and 90 days, but that's after you've put together a full package. And by a full package, I mean all the different materials that a bank is going to want to look at. So that's usually 12 months of bank statements, 2 to 3 years of tax returns, 2 to 3 years of financial statements, personal guarantees, personal performance statements, and we'll get into some of that criteria later. But typically, putting all that material together can take a couple weeks, and then the actual time of underwriting, because they have some of the lowest rates, is longer. Because back to what we said earlier, rates usually go hand in hand with risk. If we work to our right, we can see unsecured term loans, unsecured lines of credit, cash advances, equipment leasing, invoice factoring, and unsecured consumer loans. So here these are, a lot of, and I would say in each one of these categories, we probably have hundreds, if not thousands, of individual financial institutions. So we kind of want to understand what's out there and then what's applicable to us. But when we're talking about e-commerce sellers and we're talking about online businesses, one thing that we always want to remember is a lot of times traditional lenders and institutions don't always understand how our business works. So on the next slide, I kind of break down what our options look like that are actually the right fit for e-commerce. So on the left-hand side, we can see fast approvals, flexibility, e-commerce friendly, daily access to funds, and limited financials. So by fast approval, we mean it's pretty self-explanatory. How quick is the approval process from when you apply to when you're approved? Flexibility is how flexible the financing programs are for your business. Some examples there would be, are they going to dictate exactly how you use the funds? Are they going to demand that you use capital and specific timings? E-commerce friendly is, do they understand e-commerce? Do they understand the business? Typically, a lot of times, older traditional lenders, sadly, they still kind of look at e-commerce as almost a fad. And unless you're doing, upwards of over $10 million, they find it very risky and oftentimes don't even know how to understand what they're looking at. Daily access to funds. Does that mean you'll be able to receive cash flow on a daily basis, or is it going to be one big lump sum that you then have to plan and budget for yourself? And then limited financials. Limited financials here, we're kind of describing how much paperwork you need to give them, whether it's tax returns, bank statements, or everything in between. So as we look at the chart, we can see that when we look at traditional bank loans, while on the earlier chart when we were looking at bank loans and SBA loans, we saw they did have some of the best terms and some of the longest rates, but they typically don't have fast approvals. They tend to be not very flexible. A lot of times, like as I was just saying, they don't really understand e-commerce. Typically, you're going to be getting just one lump sum of capital, and it's up to you to kind of plan for it. And then with limited financials, usually banks are asking to kind of see everything. They want to know about you, the business owner, individually, and they want to know about the business. So that can be tax returns, it can be bank statements, it can be personal guarantees, They might want to see some statements from maybe invoices or statements from wherever you're selling. Um, and probably, even more stuff than that, like depending on how much, if you're a current customer of the bank or not. Oftentimes banks want you to move your deposits over to their banks and have a banking relationship with them. Lines of credit. Here we're talking about lines of credit from traditional lenders. Again, it's a very similar approval process to the bank loan on the left. There is more flexibility, though, if you are approved for a line of credit, as you're able to draw down the account and use the cash as needed. They can be very e-commerce friendly, not necessarily the application process, but once you've been accepted to it and the way you can use the funds. There would be daily access to funds and that you could draw down your capital line. But when it comes to financials, they're going to ask for all the same type of stuff that a traditional bank would. If we jump over and move to the right and go to invoice factoring, it's typically not a fast approval. It's typically not flexible. They're factoring an actual invoice. It tends not to be e-commerce friendly because when we're talking about a marketplace like Amazon, we're selling through Amazon but to consumers. And for the most part, most factoring companies can't actually factor consumer receivables. There isn't daily access to funds. You receive cash per invoice, and it requires a pretty significant amount of financials. When we look at credit cards, whether it's personal or business, tend to be pretty fast approvals. It's usually based on the FICO score of the owner, or in the case of personal scores, it's based on your FICO score and your DTI. And we'll get into some of those explanations in a couple minutes, what those mean. They're very flexible. You can kind of use as you want, as long as someone accepts credit cards. You have daily access to your credit card as long as you haven't gone over your limit. And typically it's limited financials. They usually just want some high-level information on you that they can get from a credit report. When we talk about venture debt, the approvals are not fast. They tend not to be flexible. They're for specific purposes. Venture debt can be e-commerce friendly if you have a big enough business and you have the type of model business where they feel that your business can grow. But there isn't daily access to funds, and they ask for a lot of financials as well as business plans and information, typically resumes and things like that on the owners. And then I left, our company Payability last, and I think, frankly, I think we do a great job with e-commerce businesses in that we do have fast approvals. We are very flexible. We are built specifically for e-commerce and marketplace sellers. We provide daily access to funds, and we really don't ask for any financials at all. So let's talk about some ideas of understanding if we're qualified. Listed on the screen, we can see some metrics that financial institutions use. So let's go through each one just a little bit one by one so we have an understanding. So the first one is FICO. There are several variations of the FICO score, but FICO still remains one of the largest tools lenders use to evaluate risk. FICO scores can range from 350 to 900, depending on which score they're using. And the scores are generated from the 3 credit bureaus, Experian, TransUnion, and Equifax. When a lender pulls a score from one bureau, that's called the soft pull, and doesn't have any effect on your credit. And when a lender pulls from all 3 bureaus, that's called a hard credit pull, and can affect your credit score slightly, usually around 2 points, and can potentially be seen on your credit report, meaning that the other bureaus would see that it was pulled. DMB stands for Dun & Bradstreet. These reports are used by many traditional lenders, as well as by many credit departments that issue trade credit. DMB has several scores, including the Paydex score. Among other things, DMB is used to measure the health of the business and their credit history with trade credit, which means paying on terms to their vendors and suppliers. Oftentimes, if you're looking for trade credit from, let's say, a manufacturer or a wholesaler or a supplier, meaning you're looking for like 30-day terms, a lot of times a Dun & Bradstreet score is what they're going to pull on your business to have an understanding about what your payment history looks like. PayNet is another score similar to DMB. It measures the health of a business and their ability to pay suppliers and vendors in a timely manner. Business credit reports. Each personal credit bureau, Experian, TransUnion, and Equifax, they also provide business credit reports. Besides general information on the business, they're used to look at the overall health of the business and things like judgments, bankruptcies, liens, and credit lines to get an understanding of a couple things: how well the business is doing, what their likelihood is to repay, and if there are any liquidity risks. DTI. This means your debt to income. Often used in consumer lending, it can also be used in commercial lending when trying to assess the riskiness of lower rates and longer terms. Essentially, it's just a simple ratio of what your current outstanding debt is to your total income. LTV. This stands for loan to value, and it's used when taking a loan to purchase an asset. So if we had a building, or we were looking to buy a building, or a vehicle, or maybe like a forklift or something similar, they want to understand what the loan to value is. The loan to value is the percentage of the asset to the loan taken to purchase the asset. For example, if we were to buy an asset for $100 and finance $80 of that purchase, the LTV would be 80%. PFS. This stands for Personal Financial Statement. PFSs are used with government and traditional lenders, as well as lenders that are giving the lowest rates and longest terms. PFSs list all your assets and all your liabilities and allow lenders to see your individual DTI, as well as what types of collateral you might be able to pledge. Business plan. A business plan, I think most companies maybe know what a business plan is. I would recommend, if you've never done a business plan, it's an excellent exercise whether you're looking for financing or not. Because really what a business plan is a document setting out your business's future objectives and strategies for achieving them. Typical topics covered in a business plan are the addressable market, the sales and marketing strategy, the financial background, projected profit and loss, and the bios or resumes of the management and operational team that will execute the plan. Other metrics lenders use that we can see on the right-hand side are what industry you're in. Different industries have different inherent risks. Are they seasonal? Do they have more regulation than others? Are they tied to other industries and companies too closely? Do they have customers who are known to not pay their bills? All these factors can affect the riskiness of a company. Location. The location of your business is used by lenders because some lenders only lend within the state they're in. Some lenders will lend only within the country they operate. Some lenders lend internationally. Some lenders, in fact, only even lend in like the community that the bank resides in. Time in business also can be seen by some lenders as TIB. Time in business is how long the company has been in business, and is probably one of the most important factors lenders look at. It's not always as easy as it sounds. Has the company been in business for 10 years, but you just bought the business 6 months ago? Have you been in the industry for 20 years, but your new venture is only 1 year old? Were you a previous employee of a company that you purchased? All these factors should be explained to a lender to put you in the best light. Lenders are worried that new companies have a greater chance of failing. So anything you can do to alleviate that worry will work in your benefit. Annual revenue, probably one of the biggest factors for companies already in business. Often heard in other terms, it can be gross revenue, ASR, which is annual sales revenue, GMV, gross merchandise value, or sometimes GMV, gross market value. Sometimes lenders want to know your top line revenue. Sometimes lenders want to know your net revenue after expenses. Sometimes they want to know your EBITDA, which is earnings before interest, tax, depreciation, and amortization. Knowing which revenue metric the lender uses is usually necessary to understand if you're fitting within their guidelines. Collateral. Collateral is an asset that we're pledging as security for repayment of a loan, which will be forfeited in the event of a default. The easiest way to think about collateral is in the case of a home mortgage. In the case of a mortgage, the home is the collateral. Bank statement review. Some lenders look at bank statements, and typically what they're looking for are a couple of different types of risk indicators. Monthly deposits is one of them. This usually means how much in a dollar value is the company depositing, as well as how many physical deposits are you making per month. Negative days, which refers to the number of days the account balance finished with a negative balance. Negative days are closely also related to NSFs, which are non-sufficient funds. This is how many bounce payments you may have made throughout the month. Underwriting teams also look at bank statements to see if you have other financing, by whom, and how much you're paying. In some instances, underwriters are also getting an understanding of how your immediate cash flow looks, as well as if your spending habits are primarily business related. And then we have financial statement review. Often used by traditional lenders, they're going to look at a handful of, really a couple of financial statements. Your profit and loss, or your P&L, also known as your income statement, gives underwriters an idea if your business's overall health and see if you have enough cash resources to continue operations and pay off debt at the same time. The P&L statement breaks down sales and expenses into all of its components while also highlighting net profit. Balance sheets, which are examined to help underwriters determine what is owned, assets like cash, property, equipment, accounts receivable, etc., and what is owed, liabilities like accounts payable and debt. This gives underwriters a detailed description of the business and what would be available in the event of a default. For certain loans, both personal and corporate tax returns are required, and often the last 2 to 3 years of filed returns. Tax returns are often used to verify some of the information on the financial statements, as well as have an understanding of what the owner's personal liquidity is. So, now that we went through a couple acronyms and understood some of the terms, I think to kind of just dive deeper into rates and terms, I think we want to understand maybe, what does financing cost mean and how do I calculate it? So financing cost is the dollar cost of interest and other charges involved in the attainment of funds. One of the simplest ways to think about how to calculate this is by looking at the amount you actually received and deducting it from the total amount owed, while keeping track of additional charges that were or will be incurred. Knowing your financing cost is critical when measuring the ROI on taking up financing. So what is interest? Interest is the money paid regularly at a particular rate for the use of funds. Oftentimes when you see interest and not APR, they're referring to simple interest, which is the financing charge, not including fees, that you assess for receiving funds. So what is APR and why is that different than interest? APR is the interest rate for a whole year, rather than a simple interest rate or a monthly fee, where a rate is applied to a loan. Where the confusion about APRs usually exists is when dealing with non-loan products like factoring. APRs should only be applied to loan products that have an amortization schedule, as it can often poorly reflect the true financing cost when talking about short-term financing programs that aren't actually loans, like advances, factoring, merchant cash advances, and others. A lot of times what we see I think with APRs, what really happened was in the home mortgage market, as well as the credit card market, we wanted to have an ability to be able to measure things apples to apples. But unless we're talking about really actual long-term products, APR is not always as applicable as looking at what the true financing cost is. What does unsecured mean? Unsecured means that the funds received from a lender are not tied to any pledged asset as collateral. Typically with unsecured funds, there is little to no restrictions on how the funds can be used. Collateral we stated earlier, but that's an asset that is pledged as security for repayment of the loan. LTV we also went in earlier, but it's the loan to value that is the percentage of the asset to the loan taken out to purchase the asset. So here, just a couple other points about understanding rates and terms is what's wrong with having a lower monthly payment and a longer term. And the problem with having a lower monthly payment and longer term can be seen in the overall financing cost, kind of like what I was talking about in APR. There are times when if you have short-term financing, the rate will look higher and the individual repayment amount, whether it's daily, weekly, or monthly, might seem higher. But when looking at the overall financing cost and the actual interest we owe, it can actually be much less. And that's because when we have a lower APR but stretched over a longer term, we're paying interest for a longer amount of time. So to go back to the mortgage example, If you look at a 10-year mortgage versus a 30-year mortgage, or if you looked at short-term financing that might make you pay a much higher monthly rate to buy something in a year versus the amount of interest you would actually pay on a 30-year mortgage. When we look at a 30-year mortgage, a lot of times the interest you pay is almost the same exact amount as the purchase price of the house. So there's benefits to be had from both. Sometimes having a longer term gives you a lower monthly or weekly payment, which makes it easier and immediate, but the actual financing cost was higher. So we always just want to understand what our financing cost is compared to what we're trying to achieve. Because if your financing cost was more expensive than your ROI or return on investment, then even though it seemed like it was a better fit at the time, it might not actually be a positive for you. So to finish up here, what is a UCC? A UCC stands for Uniform Commercial Code. When the term is used in financing, it's typically referring to a UCC-1 filing, which is a legal form that a creditor, and when I say creditor, think lender, files to give notice that it has or may have an interest in the property of the debtor. This is also used in the case of liquidations or bankruptcies to tell the courts who is owed and what the order is. Oh, I forgot one. Personal guarantee versus performance guarantee. A personal guarantee is an agreement that you make to be held personally liable for the loan to be repaid, whereas a performance guarantee is it's a little different. In a performance guarantee, you're guaranteeing that you will not prevent a lender or funder from collecting payments, either through diversion or changing your bank account. So finally, how do we benefit? So I think when we're talking about, taking on financing and the financing landscape, we kind of want to break out. We have loan products that give us a big lump sum, or advanced products that can give us a lump sum of capital that we can use to purchase inventory and grow our business. And then we have different types of cash flow tools, like what we do here at Payability, or a line of credit if you're approved for it, that allow you to have a trickle down effect on your business. Whether it's paying bills, buying inventory, or reinvesting in the business, having cash flow allows you to essentially smooth out the financing of the business, which allows you to budget for the future, budget what you're doing now, be able to understand what your cash flow looks like as far as being able to forecast what you'd like to do in the future, and be able to create, 3, 6, 9, and 12-month plans for where you see the company going. A lot of times when we're starting out a business or when we're looking at different financing options, it's often tough to say, I don't know what the business is going to do 6 months from now. I don't know what the business is going to do 12 months from now. Because, in the case of selling on Amazon, oftentimes we're being paid, twice a month, which it doesn't create the smooth, consistent cash flow that allows us to plan for the future. So using different types of financing options that can create additional cash flow allows you to be able to essentially smooth out the cash flow overall and be able to budget and forecast. And that's it for the presentation side of the webinar. And I would say anyone who is interested in cash flow or different types of solutions we provide for different e-commerce merchants, marketplace sellers. We have we're digitally automated, and it only takes about 10 minutes to do an application, but we also have real humans here too. So we'd love to talk to you.
And I think we had discussed that you guys had kind of done like a survey with a bunch of people, a bunch of businesses that started using Payability, and how kind of their growth was, a little steady, and then a couple months after, like a hockey stick.
Yeah.
I think that decision as a small business owner to take on financing or to take on some sort of cash flow or some sort of way to help you have more cash flow, it's a scary decision. But when you see like stats like that right away, it makes it kind of seem like, okay, I can do this, just because I go into needing financing this way, or, reaching out and doing instant access and getting paid the day after I make sales. It doesn't mean that I'm suddenly going to feel like I'm swimming in debt. And I think sometimes at small business owners, you work so hard, you're kind of like, I don't want to owe anyone anything. Um, that it's hard to make that initial leap. But once they do, the majority of them see quite a bit of success. At least that's what you've been talking with me about over the past couple of weeks.
Yeah, and I think that's exactly right. We went into I went into a little nitty gritty, obviously, during this webinar because I really want everyone to understand all the options out there. Because hopefully we're not all small businesses. Because hopefully we grow, and I ideally ideally we're buying buildings and we're growing these large enterprises, but we have to start somewhere, and that's where our access product is actually amazing for sellers of all sizes because it's not a debt product. It's essentially giving you your own money that you've already earned faster so you can be able to put it back to work. And if we think about the compounding nature of e-commerce in general, um, I think we touched on this on one of the podcasts. In e-commerce, we're able to be open 24 hours, 7 days a week, 365 days a year. And that allows us to always be selling if we always have inventory to sell. And one of the issues and challenges on Amazon is they will throw demand at you. And we need to be able to keep up with that demand. And to be able to do that, we need to be able to take, at least in the beginning, we need to take every dollar we've made and put it back into the business. And if we can shorten that cash conversion cycle, if we can shorten that window of when we can reinvest it back into the business, it means we can constantly, essentially, exponentially scale the business up and up and up. And what, you might have been doing 1,000 in your first month. And now by having more money in your hand, you might be able to get that to 2,000 or 3,000. And then we've seen it jump from 3,000 to 10,000. We've seen it jump from 10,000 to 30,000. And it's because there's nothing stopping you from being able to sell when you're online, except for running out of inventory, which is why it's so important to have consistent cash flow funneled into your business.
Because you don't have to wait those 2 weeks for the next disbursement to take that money and order new inventory. Instead, you can take it the next day, pump more inventory in. That's kind of it kind of has that compounding effect because you don't have to wait. You can just continue to pump money every single day back into either, buying inventory or frankly, buying help too, people to help you grow the business.
Whether it's helping people to grow the business, whether it's marketing spend, whether it's inventory, there are things that we can do that grow our business. I would say if you want to use daily access to go on a vacation, there might be better programs for that. But when you want to grow your business, you need to do things that have proven ROI on your business, and that's reinvesting in inventory and growing your product catalog. That's investing into marketing, and that's usually bringing on other people that can help you out and being able to constantly compound it. It's we see the proof every day, and it's even some of our biggest sellers, they take advantage of it because a lot of them, and they have plenty of money, in their bank accounts, but they say, why would I turn the engine off? Let's keep this engine running. Let's constantly keep building the business up and building the business up.
Mm-hmm. I'm going to go to this question from Steve. He did say sorry if you answered this earlier and he missed it, but he's wondering if you could kind of walk us through, give us an example of how fees work. He said, I looked online and saw it's a flat fee structure. Could you explain a little bit more?
Sure. So when we're talking about our access product, we essentially take a flat fee, and the fee is it can vary usually between 0.5% and 2% of the gross sale amount. So if we were to do, let's say if you had made $100 in sales, we would charge you anywhere between 50 cents and $2 to be able to make today's sales available to you tomorrow. And then essentially you would receive money from us. You would have your Payability dashboard, which we can see on the screen a little like a picture of it, and you would be able to the money would be made available to you by us, and you would be able to transfer the money to your bank account via wire or ACH. We can do instant transfers, or we also actually have our Payability seller card, which if you sign up for the seller card, the money will also be available on the card, and then we give you 2% cash back for every dollar you spend by using the card. But essentially, that's how it would work. So for 14 days, we'd be making today's sales available to you tomorrow. We'd be taking the fee, whether 0.5% to 2%, depending on the size and the risk and what the underwriting score comes back to. And that has to do usually with chargebacks and suspensions and things like that. And then in 14 days, when Amazon releases the full amount to us, we give you the remaining 20% back. And then that's how it works. So we would advance 80% of today's sales tomorrow. We would charge the fee, and then in 14 days we would release the remaining 20% back to you.
Okay, and just that 20% stays there as a way to cover if there's any sort of issues. Amazon has returns that they need to deal with, or if there's some sort of problem with inventory. That's the reason for that 20% staying there.
That's exactly right. So, we're working after the fact in that you've already made the sale. But as we know, people return items oftentimes, and there's still that lag of, a chargeback, return, or maybe like something was shipped late, so there's like a fee there. So it's really just to compensate the risk of sometimes we've had customers who, I don't even know if it was fault of their own, but like, I think when you deal in clothing especially, a lot of times it's not your fault that you're getting returns. People buy something that doesn't fit, or maybe they buy three shirts or three sweaters to try on find the one that fits, and then return the other two. And again, it's not any fault of your own. We see it all the time in shoes. Sometimes shoes don't fit, but I'm a size 12. I ordered a size 12, but it, the shape and the fit, it really felt like an 11 and a half or an 11. So I'm going to return it. So it's not because you had a defective product, it's just a return. But sometimes those returns happen, and we need to make sure that we have a little bit of a reserve left, essentially for those type of issues.
And I'm guilty. I'm the person that I order multiple sizes and try on what, and then return what doesn't fit. Steve has a follow-up question. Can you have a lower fee and be paid only twice a week or something like that? Or is it only every day?
So typically we work every day, but our account executives are, again, we have real humans. We're a financial technology company, but we have real humans on the phone. So I would say, you can follow up with me after the webinar is over, or reach out to one of our account executives. Say that you saw this webinar and you had a question. We usually want to try to be as flexible. We pride ourselves on having flexible financing. We try to be as flexible as possible. So I wouldn't say that is a hard no by any means.
Okay. So I appreciate that. I like that you're willing to, reach out to us. Let's have a conversation. We're real people too. Let's make it work for you. And I think that's kind of the whole goal of Payability is, we understand small businesses and how small businesses work and how they run. And so come and trust us. And you guys have larger brands too, but come and trust us. Help us, let us help you grow your business. And when you say us, it's real people. It's people like you. And there's at least, I know at least one other person that works there, and she's also a real person, which is wonderful to have. What do you kind of see as the future of e-commerce when it comes to kind of the financial world? Obviously, don't reveal anything you're working on that you're not ready to announce yet, but kind of where do you see the future going? Because e-commerce won't go away. So what's the future for you guys?
So it's, I would love to tell you about a new product that we have 2 new products that we're working on that we should be launching at the beginning of next year that I think will be incredibly exciting. That if I could tell you about them right now, it would completely answer that question, because I do think it's actually the future of where financing for e-commerce is going. But in general, on a high level, I think the future for e-commerce is being faster, I think all e-commerce businesses are looking for speed, but also coupling that speed with actual human interaction. When we're talking about business, we're talking about finance, being able to talk to someone, and I think this is a problem that some of the marketplaces, some of the complaints they often get is, it's very hard to get someone on the phone. And sometimes a quick, simple, easy question, no question and answer would relieve so much stress and anxiety in our lives if we could just hear somebody just give us the answer instead of us panicking and freaking out for like an hour trying to find the answer online. And I think, and that's why a lot of people go on the forums so they can actually talk with each other. I think coupling speed, flexibility, larger dollar amounts, lower fees, and just, with also having a human touch, I think is a really important factor. Um, Again, I'd love to follow up with your audience in like a month or two when we have our new products out, because I think that's going to be somewhat revolutionary in the e-commerce space. But what I also see happening in the e-commerce space is we have this interesting world of almost like a crossover between, and this happens a lot in small business, but there's almost crossover between, should I treat you as an individual consumer or should I treat you as a small business? If I'm one individual, whether I have an LLC or an S Corp alone or not, if I'm an individual and I'm selling online, there are usually hard lines in the sand when it comes to banking and different types of products. If you're a person or a consumer, I treat you one way, and if you're a business, I treat you another way. And I think we're entering a world with between the gig workers, online businesses, online workers, people working from home. We need to get out of this mentality of business is brick and mortar and really completely get out of the mentality that business is definable. And I think that's where so many different types of products, and especially in the lending world, go wrong. Is they think that they can basically make three personas for the entire population and say your company looks like this, your company will look like that. And what I see is hybrid models of all of that kind of converging and bridging, and treating online sellers as they should be treated. As you're an individual and you're also a business, and I have products that make sense for both of that field.
Awesome. So we've got a couple more questions. I'm going to go to Matt. He said, "What's the best option for debt consolidation?"
I'm sorry, could you repeat it one more time? I was realizing our we need to plug in our computer here.
Oh, no, we don't want you dying on us. So Matt wrote, "What is the best option for debt consolidation?"
Um, I think it would depend what type of debt. So there are a lot of great, and I think it depends on what type of debt and the size of the debt. So if we're talking about personal debt, like we're using personal credit cards, I think there's a lot of great online consumer lenders that do a really good job consolidating debt, whether it's Marcus by Goldman Sachs, SoFi, Lending Club, Prosper, Upgrade. Payoff is literally designed just to consolidate debt. I think where the online consumer loan world has really taken off is by doing just that, is consolidating credit card debt into a fixed loan payment, usually with like a 3 to 6 year duration, depending on your credit score. When we're talking about business debt, we're essentially looking for the same thing. When we want to consolidate debt, and again, I would need to know a little bit more about the debt, but if it's a handful of short-term debt, we want to essentially finance all that debt into one chunk that gives us a nice monthly payment to take it to a higher level. If we're trying to consolidate anything, we want to basically be able to pay it off all in one shot, so I don't have 3 or 5 or 6 things over here, and now I just have one thing on the side. And we want to try to stretch that term as long as we can with the rates as low as we can, to basically, and we want to find someone that doesn't have a prepaid penalty. That way, ideally, the longer you have something outstanding, the more interest you're going to pay. But we want to make sure that we can get that payment down to an amount low enough that it makes sense for us. Because oftentimes when I would see customers come over who need to consolidate debt, it's that individual, whether it's daily, weekly, or monthly payments, are starting to really become a constraint. So we want to typically get a longer term. That way we can get a lower payment. But then once we have the debt handled and we're growing our business, we want to make sure we pay that debt off as fast as we can, so as not to pay too much in interest and have a financing cost that is too high.
Okay. Let's jump to Andrew. He asks, he says, we are a UK company but sell exclusively in the US on Amazon FBA. Are we able to use your services, or do you have to be based in the United States?
Oh, Andrew, you can definitely use our services. We work with sellers all over the world. We just actually had, like right before I came on the call, we just had a new seller from India and Indonesia come in at the same time. And I tend to watch all the new deals that come in because I just find it incredibly interesting how many companies we work with. But we can work with any company anywhere in the world as long as they're not on the OFAC list or any type of restricted list, and they're selling on a US-based marketplace. We're looking to work with international marketplaces next year. But for right now, as long as you're selling on a .com, Amazon.com, Etsy.com, eBay, as long as it's a US-based marketplace, you can be anywhere in the world. And we even have a partner with a great company, OFX, that does current Forex solutions for us. So you can actually get paid in your home currency as well.
Okay. Um, Anything else that you want to add? I mean, I know I will be messaging you in a couple weeks and saying, hey, let's talk about 2020 and what's coming for 2020. And, especially once we kind of get through the first busy holiday season, we'll be all looking ahead for ways to grow and improve in 2020. But anything else that you would like to add in our last few minutes here?
Um, I would say that we're still in the middle of that holiday busy season. So we still have customers. We're still signing up customers. We sign up customers every day. Don't think that there's not still opportunity to have at this time of the year. Um, it's still a buying opportunity right now, especially with next day delivery and all these things. The idea that everyone just buys on Black Friday or Cyber Monday is kind of gone. I'm a guilty person who literally doesn't do any of my shopping usually till around the 18th through the 20th of December, because I know I could just usually get it next day delivered or something similar. So there's still a tremendous amount of opportunity left in the year to keep growing our business, keep having big sales, and kind of finishing the year strong. I would say for any of those interested in what we do over at Payability, reach out to us. We're always happy to have a conversation and see how we can work together.
Well, Alex, thank you so much, and thank you everyone who joined us. We will be this was recorded, so we will be uh, saving it and sharing it probably in the next day or so. But thank you guys. Thank you, Alex. We'll talk to you soon.
My pleasure. Thank you for having me.